Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates. 10-year note yields saw its sixth consecutive week with a higher mark. So we just continue to push higher. Now, if you came in on Monday, you'll note that we were trading around 287 yield, and when we closed on Friday, we were also trading around 287. So at the end of the week, we didn't really see a significant shift in the market. However, we did test near 295, and we extended that week over week increase that we've been seeing. A lot of it has to do with a lot of technicals, but there's also a lot of supply coming, a lot of uncertainty in Washington. Stronger inflation data that we got midweek was really one of the things that propelled us after we saw that higher average hourly earnings number the first week of the month. So there's a lot of reasons why yields are going higher here, but sort of spinning our tires this week as we wait and saw what equities did. They recovered. We saw what's happening in the commodity markets. We saw gold recover, although oil didn't. And I think that right now it's all about what the next catalyst is for the bond market. And there's a lot of them coming up. And we'll talk about that in 1 second. But first I want to look at volatility, because volatility skyrocketed 2 weeks ago when we saw the market all awry, when we had stocks getting hit down 12%, and we saw the bond yields rising very quickly, and we saw volatility really take off to levels we haven't seen in a long time, going back over a year. So that obviously didn't sustain the fact that we saw the bond market kind of hold its range, although it did extend its range at one point during the week. Volatility started to decline. It's still elevated from where we've seen the norm, if you want to take like a 14 or 30-day moving average, but we're just not on those highs, and we're not showing any real fear in the market right now. It doesn't seem there's any urgency in the market right now until that next catalyst comes. And what will that next catalyst be? Well, next week we get Treasury supply. I think that'll be one reason. We get FOMC minutes from the January FOMC, where the Fed had talked about inflation. And yeah, I know you can go pretty much back over every statement, and they talk about over the last couple of years where they say inflation's coming. Well, it's now here. We're starting to see it. And it is the beginning stages of inflation we saw in CPI and average hourly earnings. And we'll get the PCE data, and that will maybe be the piece that's missing. But ultimately, these minutes will tell us maybe how aggressive the Fed wants to be as they enter into the March meeting, which is expected to raise rates. And then again, we're looking for a rate hike probably mid-year in June, and then again in December. But could they sneak in another rate hike? And I think the market's kind of waiting. That could be the kind of catalyst that the bond market is waiting for. Likewise, I don't think the bond market believes that stocks are bulletproof here. I think that yes, we've seen a recovery from those massive sell-offs, but certainly you have to be scratching your head and saying, well, if that happened then over a period of only a few days, we saw a 12% down move in the equities, it could happen again. So right now there's a couple of things out there. Risks are on the rise. And I think that right now the bond market, again, is waiting for that catalyst. Whether it comes from the Fed, whether it comes from Washington, or whether it comes from the data and the equity markets has yet to be seen. But right now we're on our path to testing 3%. And once we get there, I think we're also going to find a sustained period where we trade there and again wait for the next move, whether it's more aggressive Fed, less aggressive Fed, or if equities can resume their new highs. I think that Treasury yields will join them and continue to rise. But right now we got to wait and get through next week with this Treasury supply, FOMC minutes. This is Todd Colvin coming to you from the floor of the CME Group.